Most people use the same investment strategy their entire life, and that's exactly why they struggle. You see, sticking with a single investment approach year after year through all of life's changes is like trying to wear your college clothes when you're 50. It just doesn't fit anymore, does it? It's uncomfortable, it restricts you, and frankly, it probably looks a bit silly. In the world of money, it's not just uncomfortable, it actively hinders your financial growth and can leave you scrambling when you should be comfortable. Today, we're going to pull back the curtain on why your investment strategy absolutely must evolve as you age, why your risk tolerance shifts, and how your time horizon dictates everything. We're breaking down exactly how your investments should change from your 20s all the way through retirement, ensuring your money works as hard for you as you do for it. The biggest mistake I see investors make, from wide-eyed 20-somethings to seasoned professionals nearing retirement, isn't picking the wrong stock. It's the silent, slow decay of an outdated strategy. It's the belief that what worked at 25 will still be perfect at 55. And that's just not how life or money works. Your life changes dramatically over the decades. New jobs, marriage, children, mortgages, paying for education, and eventually the dream of retirement. Each of these milestones dramatically shifts your financial landscape, and your investments need to shift with them. Because if they don't, you're either taking unnecessary risks, leaving serious growth on the table, or both. So, how do we fix this? It all boils down to a simple, fundamental equation. Your asset allocation, your time horizon, plus your risk tolerance. This isn't just a fancy formula. It's the bedrock of smart investing. Let's peel back the layers. First, time horizon. Think of this as the runway you have until you need to access your money, usually retirement. If you're 25, your time horizon might be 40 years. That's a long runway. If you're 55, it might only be 10 years. The length of this runway dictates how aggressively you can invest. A longer time horizon means you can afford to ride out the market's ups and downs, giving your money more time to grow. A shorter time horizon means you need to prioritize protecting what you've built, as you have less time to recover from a major dip. Next, risk tolerance. This is your personal comfort level with potential market swings. How much sleep will you lose if your portfolio drops 20% in a year? Are you the type to panic and sell, or do you see it as a chance to buy more shares at a discount? Your risk tolerance isn't static. It changes as your life changes. When you're young and don't have dependents, you might be okay with more risk. When you have a family and a mortgage, that comfort level usually shrinks. Understanding both your time horizon and your evolving risk tolerance is key to building a portfolio that not only grows, but also allows you to sleep at night. Let's dive into how this plays out across different stages of life, moving from aggressive growth to smart protection. Your 20s, 30s, the growth rocket. When you're in your 20s and early 30s, your time horizon is likely decades long. Retirement feels like a lifetime away, and that's a powerful advantage. This is your prime time for aggressive growth. You want to take full advantage of compounding returns, letting your money make more money over a very long period. Your asset allocation here should lean heavily, and I mean heavily, into stocks. Think 80% to even 90% in equities. Why? Stocks offer the highest potential for long-term growth. Yes, they come with more volatility, but with a 30-40-year runway ahead, you have plenty of time to recover from any market downturns. In fact, for a young investor, market dips aren't scary. They're opportunities. They're like a sale at your favorite store, allowing you to buy more shares of quality companies at a lower price. This is where you capitalize on market upturns, letting the rising tide lift your financial boat significantly. Embrace the volatility. It's your friend. Consider someone like Sarah. Fresh out of college, she starts her first real job. Her only financial responsibility is herself. She allocates 90% of her 401k to a broad market index fund, knowing full well it might swing up and down. But she consistently contributes, understanding that every market dip means her regular contributions are buying more shares. This aggressive stance, fueled by time, sets her up for massive potential growth down the line. Your 30s, 40s. The balancing act. As you move into your late 30s and early 40s, life often gets more complex. Maybe you're married, have a mortgage, or little ones running around. Your financial responsibilities are growing, and your risk tolerance might start to naturally shift. While you still have a significant time horizon, it's not quite as expansive as it once was. This is the balancing phase. You're still focused on growth, but you're starting to introduce an element of stability. This means gradually adjusting your portfolio to decrease your stock allocations slightly, perhaps to 60–70%. And what do you introduce? Bonds. Bonds, though less exciting than stocks, play a crucial role. Think of them as the steady anchor in your portfolio. When the stock market gets choppy, bonds tend to hold their value or even increase, providing a buffer against major downturns. A typical allocation here might be 20–30% in bonds. They help smooth out the ride, protecting some of your accumulated gains while still allowing the majority of your portfolio to pursue growth. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning, so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure. I may earn a commission if you sign up using my link at no extra cost to you. Mark, in his late 30s, has 2 young children and a home. He still wants his money to grow aggressively, but a major market crash now would feel a lot more impactful than it would have in his 20s. He decides to dial back his stock exposure from 85% to 70%, putting that 15% into a diversified bond fund. He's not giving up on growth, but he's building a stronger foundation to protect his family's future. Your 40s, 50s. The protection phase. By your late 40s and early 50s, retirement isn't just a distant dream. It's a rapidly approaching reality. Your focus shifts significantly towards safeguarding the wealth you've diligently built. While growth is still important, preserving capital becomes paramount. You have less time to recover from substantial losses. In this phase, you'll continue to reduce your stock allocation further, perhaps to 50–60%. And naturally, your bond holdings will increase, potentially to 30–40%. You might also start looking at other, less volatile assets to diversify even further. The goal here isn't to hit a home run, it's to consistently get on base and avoid striking out. Consider Maria, 52. Her kids are in college, and she's planning to retire in about 10–15 years. She's seen several market ups and downs throughout her career, and while she benefited from the growth, she also felt the sting of the drops. She now shifts her portfolio to 55% stocks and 45% bonds. This mix still provides some growth potential, but significantly reduces her exposure to major market swings, ensuring her nest egg is well protected as she nears retirement. She's prioritizing preservation, knowing that big losses now could seriously delay her retirement plans. Pre-retirement. the final transition. You're just a few years away from clocking out for good. This stage, typically the 5 to 7 years leading up to retirement, is all about the final conservative adjustments. Your portfolio needs to be ready to transition from accumulation to income generation. Your portfolio becomes even more conservative. A common target here is roughly 40–50% in stocks and a matching 40–50% in bonds. Some might even go slightly higher on bonds if their risk tolerance is very low. The goal is a delicate balance. Retain some exposure to growth so your money doesn't just sit still, but heavily prioritize protecting what you have. You want to ensure that if there's a market downturn right as you're about to retire, it doesn't derail your plans entirely. This is about building a stable bridge from your working life to your retired life. Think about David, 60, planning to retire at 65. He doesn't need aggressive growth anymore. What he needs is stability and a predictable income stream soon. He gradually moves his portfolio to 45% stocks and 55% bonds. This gives him confidence that his retirement savings will be there when he needs them, even if the market decides to take a breather. Retirement, income, and preservation. Congratulations, you've made it. Now, your paramount objectives are income generation and capital preservation. Your portfolio needs to provide you with a sustainable income stream to live on, while ensuring that your capital lasts for your entire retirement, which could be 20, 30, or even 40 years. You'll still retain some stock holdings, perhaps 20–40%, for continued growth and to help your portfolio keep pace with inflation over the long haul. But the majority of your allocation will likely be in bonds and other income-generating assets. This could include dividend stocks, real estate investment trusts, REITs, or other fixed income instruments. The key is to manage your withdrawals wisely and ensure your portfolio continues to generate income without depleting your principal too quickly. Eleanor, 70, and enjoying retirement, has her portfolio structured for sustainable income. She has 30% in a diversified stock fund, which provides some growth and dividend income, and 70% in bonds and other income-producing assets. This setup allows her to draw a steady income each month, confident that her money will continue to support her lifestyle for decades to come, with a little growth on the side to combat rising costs. The journey of investing isn't a sprint. It's a marathon that requires constant adaptation. The crucial takeaway here is the power of dynamic asset allocation. Sticking with a static strategy throughout your life carries huge risks. Too much risk when you can't afford it, or too little growth when you need it most. By understanding how your time horizon and risk tolerance evolve, you can create a personalized investment plan that changes with you. This isn't just about making more money, it's about securing your financial future, giving you peace of mind, and ensuring your money is always working its hardest for you. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns Affiliate Disclosure. I may earn a commission if you sign up using my link at no extra cost to you. If you're ready to dive deeper into how specific investment vehicles fit into these stages, be sure to subscribe and catch the next video on the channel.